Motivated Money by Peter Thornhill. What is your benchmark? Many people often have a naive approach to returns. You will frequently hear people claim that their house purchase has been a great investment. We often apply subjective parameters when comparing different assets over different timeframes, while ignoring factors such as costs and taxes. Investment returns should be compared to a benchmark, such as a stock market index, to see how it compared over time. Choose appropriate benchmarks in life and test them regularly. People with no benchmarks are destined for standards of mediocrity. Peter's 2 simple rules of growing your wealth are as follows. Number 1, never spend all that you earn. And number 2, always borrow less than you can afford. The investment food chain. Since the beginning of civilization, there has been 3 primary assets available to us. The first, and the top of the food chain, is productive enterprise, business or shares. The next is shelter or property, and the last in the investment food chain is money lending or deposits. These haven't changed in thousands of years and still remain as the core 3 investments available to us. Other so-called assets fail Peter's fundamental investment rule. Does it produce an income? Gold, vintage cars, wine, stamps, artwork, etc. all rely on the bigger fool than thou principle. Find a bigger fool than you who will pay more than you did and sell it to them. These assets are one-dimensional as they only produce capital gain or loss and generally cost us money to maintain, store and insure. Investing versus speculating. To invest is the use of money productively so that a regular income is obtained. To speculate is to undertake commercial transactions involving serious risk for the sake of possible large winnings. We are gambling, taking huge risk with the hope of making big profits. The key to investing is to own assets that generate a rise in income and maintain their value over the long term to enable us to pursue the rest of our lives with passion and pleasure. Building wealth in the stock market. The stock market has 2 primary functions. The first is to enable companies to raise capital, and the second is to provide investors with an effective mechanism for exchanging ownership of their shareholdings in these companies. However, the liquidity provided by the market is often to its downfall, because the daily volatility of the market provides for much distraction and speculation. Peter believes that these daily movements are all noise, and we should not waste our time on this madness. We should simply ignore it and focus on the rise in income and long-term growth that the stock market can generate for us. The yield trap. People often focus too much on the current spot yield that an asset provides. Many retirees invest in traditional income investments, such as fixed income and term deposits, due to their historical higher yields. However, we need to increase our investment time frame to fully appreciate the income generated by an asset. This graph shows the capital value and income streams from an investment of $100,000 in Australian shares compared to term deposits from December 1979 to December 2019. Note that the initial starting yield was higher for term deposits. Over the period, the total income in 40 years for term deposits was $274,225, and the last income payment was $1,250, whereas the shares returned a total of $1,776,498, with the last income payment at $83,633. The final capital value for fixed-term deposits was still $100,000, compared to $2,055,350 for the shares. The contradiction is that the investment industry classifies term deposits as income investments due to the historical higher yields and stable asset base. Shares, on the other hand, are normally classified as growth assets, with generally lower yields and a fluctuating share price. However, over the long term, the total income from shares is far superior than the interest in term deposits. Despite the myths, Peter uses shares primarily for income and is 100% invested in shares and famously enjoys a $400,000 a year dividend income from his portfolio. As an investor, Peter says he cannot cope with the volatility and the risks involved with term deposits and prefers the safety and security of the share market. Safe, secure, boring and predictable are not normally associated with share investing. The reason he uses them is because he simply follows the income streams from dividends, whilst everyone else follows the madness of fluctuating share prices. So which shares to buy? Peter focuses on buying diversified listed investment companies known as LICs in Australia or investment trusts in the UK that have a long track record for paying a rise in income. These are very popular and extremely low-cost options for Australian investors. He constantly makes the point about not trying to finesse the details too much when investing. Select sensible, suitable, boring share funds with a long track record, and then do nothing and enjoy the rising income generated by the share market. Build an income stream that will grow over time. Couple this with great human relationships and passionate projects, and you will have a successful life.